This is the Asia Trade. I'm Avril Hong in Singapore. Here are your top stories this hour. Asian stocks set to follow Wall Street higher as the latest AI advances provide support for big tech valuations. Fresh US inflation and consumer data boosting bets on a Fed rate cut. The 10-year Treasury yield falls as Bloomberg learns that Kevin Hassett is firming as President Trump's pick to lead the US Central Bank. And Alibaba's ADR slipped despite strong cloud and AI growth as profit slumps at its core China e-commerce business. Now, Alibaba and AI are certainly going to shape trading in the Asia Pacific today, but it's also about central bank action. You think about the RBNZ, it is expected to cut by 25 basis points today, but the bigger question, the extent in which it's going to leave this door open for future rate cuts. We're already seeing the Kiwi dollar, the worst performer among G10 so far this year. The yen also not doing that much better, second worst performer this year. And we have the likes of a former BOJ official talking about how the weak yen could actually boost the odds of a December rate hike from the Japanese central bank. Now, in terms of U.S. assets as well, take a look at how we finished overnight. We saw stocks that surged for a third day, rebounded, continue those gains. And this is against the backdrop of that conversation in big tech, GPUs versus TPUs. We are seeing that differentiation emerging among the Mag 7s, but certainly it was about the data in the US as well. We saw how retail sales for the month of September showed us consumer fatigue emerging. And this is even before the longest US government shutdown in history. And then you think about the more recent data from the month of November, and that showed you consumer confidence actually dipped to the lowest level in 7 months. So all in cementing investor expectations that we're going to see a Fed rate cut come December. But what really was the kicker for markets were these expectations that White House National Economic Council Director Kevin Hassett is set to be the frontrunner as the next Federal Reserve chair. And this is with the search for Jerome Powell's successor now in its final weeks. I should mention that on the yield on the 10-year, it dipped below 4% handle for the first time in a month. The dollar also reacted. We saw its worst day since mid-September. Bloomberg Global Economy correspondent Enda Karan joins us now to unpack all this. So, Enda, we always knew he was among the top picks, but now he seems to be above the rest of the lot, Kevin Hassett. What do we know about how dovish he is and the extent in which his views certainly align with the U.S. president on the economy?
Well, I think exactly right, Avril. He is viewed as being in step with the president when it comes to their views on the economy. Mr. Hassett has spoken before of the need for lower interest rates. He thinks the Fed has scope to bring down borrowing costs right now. He's sketched out bigger picture views on, for example, the fact that he thinks AI is driving a productivity boom, the kind of productivity boom that will spur growth and keep inflation low, which by extension also means the Fed shouldn't be overly worrying about inflation right now. And then on the institution itself, he has been critical, not just of Chair Powell, but critical of past steps by them missing the inflation outbreak in and around the pandemic time. And he's also spoken of the need to shake up and rethink about how they view and assess economic data and how they're looking at the economy, for example. Now, to be clear, the White House has said President Trump has not made up his mind. They don't know what decision he will make, and they told our colleagues to stay tuned. We know that there is a short list of 5 that should be whittled down again over coming weeks. But our colleagues in the White House are saying that right here, right now at least, those around President Trump are saying Mr. Hassett is the one who's favoured right at the moment.
Perhaps also worth keeping in mind that there are other members on the FOMC as well. And, these Fed rate cut bets, how realistic is it in expecting this Fed rate cut trajectory, given how we also have these hawkish voices on the board?
Well, certainly we're in for a close call in December, by all accounts. The public speeches and commentary by those who are on the policy committee, Avril, making clear that on the one hand, there are those who are more worried about inflation than employment. But equally, there are those who are more worried about where the labour market is headed. We know the backstory. It's been the complication of the government shutdown, means we haven't had a lot of official data, plenty of private sector data and state level data, but not that clean read of official numbers. And in fact, we won't even get official inflation or jobs before the next meeting in December. So it seems finally poised right now. Some key voices over the past week or so have come out, like the New York Fed President John Williams making the case for a near-term rate cut. That swung market pricing back towards the possibility of a cut when they do meet in December. But whatever the decision is then, clearly heading into next year, and when that new chair comes on board, there's going to be ongoing debate and division over what the biggest challenge in the economy is at the moment. Is it inflation or is it the labour market? And right here, right now, clearly policymakers are a long way from consensus on that, and we're not getting a lot of data right now to settle the debate either.
What about the debate about Fed independence, inflation control, these longer-term considerations? Where are we on that?
Well, it's front and centre. I mean, this Fed chair process has been not just one in terms of thinking about who's best suited to run the economy and what sort of challenges the economy is presenting. It's been a very political one. President Trump has been explicit in his attacks on the Fed, on the individuals at the Fed, on the personalities at the Fed, including Chair Powell. He's made no secret of his views that interest rates should be brought down and much lower. He's regretted his decision to appoint Chair Powell in the first place. So all of this is adding to the idea that it's something of an open season on the Fed at the moment. It is meant to operate at arm's length from the electoral system. It is meant to be independent of the White House and politics. It's meant to make the best interests on decisions on the economy in the best interests of the people. And then whichever chair does come in next, obviously there will be a lot of scrutiny on, is the perception that this is going to be an extension of the White House? Is it somebody appointed by President Trump deliberately to go and bring down interest rates? Or is it somebody who will be willing to continue to navigate the Fed on an independent path and make decisions solely based on the economy? It's clearly an important juncture for the Fed, a lot of pressure on it. To be clear, it's not confuse accountability with independence. Obviously, there's a case for oversight. Plenty of people make that point. But equally, policy is meant to be made at an arm's length from politics of the day.
The overhang also is the data, right? That we don't have enough of it. There's this conversation, debate emerging whether the Fed should be delaying the December FOMC. What is your take on whether that makes sense? I mean, certainly that would give us more data, including for the month of November.
Yeah, it's tricky. We're not going to get the inflation or the jobs data before that December meeting. So that's highly unusual. We've been in a very unusual stretch here during the government shutdown when it comes to economic data. So, you know, in that respect, I don't think anybody can say they've seen this kind of sequence before. But nonetheless, the data that we are getting, it's pointing towards, at the very least, some softening in consumer confidence. Consumer confidence, in fact, has taken a significant hit, it looks like, in recent months and weeks. There's concerns among households about job security and, of course, about prices. So that's one important indicator. And we continue to get a steady kind of flow of headlines from companies and making announcements of job losses. Now, again, you get into the argument here, hang on, they're cutting staff from very high levels. Everybody overhired during the pandemic. But, of course, others will tell you it's the start of what's going to be a much slippier slope, which is potential increase in unemployment over the months ahead. So it's a confusing time for the economy, Avril. We're not getting a clean read due to the data situation. Doves are arguing, don't ignore what's happening in the labour market. And those on the hawkish side are saying inflation remains well above target, and that's what you need to be worried about.
Just picking up on your point on the consumer confidence, about job security as well, where are we on the extent in which we're seeing AI retrenchments? Or is it more about the productivity gains that, to your point, Kevin Hassett has been highlighting?
Well, it's a huge debate. Hardly a day or week goes by without a Fed official in a speech or a Q&A raising the topic of AI. And in truth, Avril, a couple of things are going on. It's happening very fast. There's both the build-out and the diffusion into the economy. Economists know, on the one hand, it's going to have a material impact, but clearly nobody knows just how it will play out. Will it be a job enhancer, or will it be a job destroyer? Will it boost productivity in a kind of a 1990s-style tech boom that allowed then Fed Chairman Alan Greenspan to keep interest rates low because he didn't have to worry about inflation? Or will it prove to be a productivity fizzer, and the end result, the end outcome is that people are more worried about jobs than any kind of productivity gains? But even though it's obviously too early to make that call right now, there are some who are in line to be the next Fed chair, including Mr. Hassett, who are making the call we're in a productivity revolution. And a lot of economists are scrambling to try and figure this out, because a lot will also say to you, the data we have right now isn't very good at measuring it, and there could be a productivity boom, but it will be too late before that's figured out. So some big calls are going to be made over the near term on AI and just how it is impacting the economy here.
And great to get your insights. Thanks so much, Bloomberg Global Economy Correspondent Ender Curran, for us there. Let's continue this conversation on AI, because it seems to be paying off for the Chinese tech giant Alibaba, though its ADRs fell after its core China e-commerce business recorded a slump in second quarter profit amid a discounting war with its rival Meituan. And that was with trading volumes double the 30-day average. This profit pinch came despite better than projected growth in its cloud business. Let's bring in our China correspondent Min Lo in Hong Kong for us. So, Min, your key takeaways from the earnings?
Yeah, I think it's pretty impressive that you look at the trading volume, how much interest there is from investors in this stock, because Alibaba really is the poster child of, China's ability to really push ahead with adoption and innovation of AI. And when you look at the earnings call, the top lines have been pretty positive. We're talking about revenue hitting 5%, which was better than expected. It was really led by the cloud division, up by 34% in cloud revenue. And that's, of course, the unit that holds its Qwen AI model. You can see here it is the main driver of revenue according to this chart. Its e-commerce revenue also seeing double-digit growth of 16%. But the downside is the bottom line. The net income is really being hit, right, by the amount of spending, hundreds of billions of yuan in subsidies and discounts in order to fight that price competition with Meituan and JD.com. And that really impacted its EBITDA, especially from the e-commerce segment, that slipped by 76%. And one analyst said that was a horrible loss. So I think that was the pain point for the company. And it's interesting, if you just watch the market reaction at the start of trading, at pre-market trading, it was up by 2%. And at the end of the day, it closed about 2% lower.
Mimi, what was also interesting was how the CEO said an AI bubble is unlikely within 3 years. And as we've seen among the US hyperscalers, they tend to get rewarded for their capex spending. What are we seeing for Alibaba?
Yeah, I mean, there has been this ongoing concern, right, about the sustainability of the AI spending. You look at Alibaba's past 3 months stock performance. Actually, it's been faring better than some of its U.S. counterparts and the hyperscalers there when it comes to the stock sell-off because of concerns over stretched AI valuations. And that's because its spending is less than the U.S. counterparts. But domestically, though, it stands head and shoulders above its domestic peers. Just to give you some context, it's looking at 380 billion yuan in spending over the next 3 years. You compare this to just 1.8 billion yuan in spending from the likes of Tencent. So a really huge difference there. And of course, the ambitions that Alibaba has is pretty huge as well. Not only does it want to be the full provider of that full tech stack, from the infrastructure to the chips that make them to the AI model and the applications on top of it, it also wants to turn its Qwen model, that app that just launched, the revamped version of it launched a couple of weeks ago, it wants to turn that into an AI agent as well that would eventually incorporate things like being able to shop for you on Taobao, being able to make travel bookings, having mapping function on it, and education as well. And it has that intense competition domestically, having to fend off the likes of Douyin's Doubao, which is a chatbot that is very popular in China as well. And of course, Tencent has similar ambitions. So it has a very strong and intense competition in China, and a lot depends on whether it can continue to deliver that cloud revenue growth.
That will be among the debates and the conversation related to Alibaba in the Asia session today. Min, thank you so much for getting us set up. Bloomberg's China correspondent, Min Lo. We have more ahead on the Asia trade. This is Bloomberg. It's a tale of two PC makers in the after hours. Take a look at how HP and Dell are doing. One is talking about job cuts. The other sees clear skies ahead. Regardless, you have the consumer malaise heading into Christmas. What is that going to mean for some of the Asia PC makers in trade today? Let's talk tech. Baillie Gifford partner Stuart Dunbar joins us now from our Tokyo studio. Great to see you, Stuart. So we are seeing, of course, these trends emerging in AI. Hi. And for PC makers, there is that soft patch there because of what we're seeing in consumers, consumer data as well. What is your sense of the strength in U.S. corporates at the moment?
I think it's pretty strong. I think there's a lot of bad news and headlines flying around, but and concerns over consumer spending. But fundamentally, we think we're seeing real progress towards the long-term things that we're interested in. So the AI front clearly is top of mind for everybody at the moment. There's been news in the last couple of days about Google and Gemini. But we're trying to focus very much on where does this take us in terms of value chain. We're trying to look beyond some of the very biggest AI firms to where is AI actually being applied, where is the value going to land. We're very much, we invest on a 5-year plus horizon. So we're trying very hard just to look through a lot of the weekly news that comes at the moment. We don't have any insight on a week-to-week basis, but we're very focused on how we think AI can change a lot of companies on a sort of 5 to 10 year view.
5-year horizon also involves looking at who the future winners might be. So when it comes to the debate between TPUs and GPUs, how are you assessing? Through what lens are you looking at these tech giants?
So what we're trying to do mainly at the moment is what are the ones in which we can be confident in. So our big positions are still in the picks and shovels makers. So, we're relatively underweight in NVIDIA, but we're big fans of TSMC. Nobody can do anything without ASML in this place. So even as this sort of tech and chip story unfolds, what we're trying to do is to find those companies that we think inevitably are at the center of it. So as we think about, where do we go? Who wins? Does NVIDIA win? I think there's a lot of customers of NVIDIA looking to try and diversify in different directions so we can understand where that's coming from. But so far, we haven't seen any evidence that NVIDIA is anything but the dominant chip maker. But we've got to watch that very carefully. Where we're thinking is that on a 5-year view, the ones that look more certain to stay on top of this are those I mentioned, TSMC and AMSL. But then I guess the other direction to take this in is the sort of peripheral players in the AI space that are maybe getting less attention at the moment. So we're interested in companies that are applying AI to make their business models better. And there's any number of companies doing that. There's Spotify, Shopify, any sorts of things. So that's the way we're trying to think about this is where does the value accrue in the AI value chain? I think anyone who thinks they know the answer to that is being pretty optimistic. So we're trying to draw down into the adjacent businesses that are actually going to use this technology and look at it from that point of view.
Does that include for Chinese tech as well? I mean, we are seeing the Chinese hyperscalers. There is a differentiation in terms of how much they're spending, how much it's paying off for them. When it comes to the likes of Alibaba, the success we've seen with Quen so far, are we in the early innings of yet another DeepSeek moment?
I don't think so. So I think that obviously there was a big wobble when DeepSeek came along earlier this year. How repeatable that is, I think, is an open question. We tend to think of China almost as a standalone ecosystem that stands apart from everything else. So there are huge opportunities there. Yeah, I saw from your earlier feature that that there's a sort of Alibaba has its own challenges at the moment with delivery wars, but there's an awful long way to go in terms of cloud services penetration. There's an enormous distance to travel in the Chinese market for Alibaba. So we're looking at that. We're kind of disconnecting that a little bit. We don't see the same penetration for the same names as we see in the rest of the world. So I guess the application of AI in some of the Chinese names is of interest to us. So we're big investors in CATL, for example. And we went to see them quite recently, and we see how they're applying AI in some of their manufacturing processes to create globally leading. They have lower costs and better products than everyone else. So I guess the answer there is on the China side, we see huge strides in the application of AI, possibly better than anywhere else, and that's moving us forward to them being able to really be quite dominant in some areas, some global areas of tech, batteries being one obvious example.
In terms of global areas, you're there in Tokyo. Talk to us about what you're seeing in terms of the potential beneficiaries. It's interesting as we, to your point, talk about China kind of on its own. Your expectation is that the likes of South Korea, Taiwan also continue benefiting. What is that going to mean for the flows in these three large North Asia markets for tech?
Well, I think my more general answer to that would be is it's amazing how large investors worldwide seem to be neglecting the opportunities that exist here in Asia in tech and elsewhere. Here in Japan, I'm here in Japan today. What are we seeing? There are particular areas of the market that we're interested in. So we're not trying to invest in whole markets, but we are looking at individual parts of markets that are of particular interest to us. So in that respect, we may see flows into Asia. I think, obviously Japan, here I am today, is becoming a very popular investment choice at the moment. We don't really look at it in terms of macro like that, but there are areas in Japan such as the gaming sector. There are parts of the health sector here that we're very interested in. Robotics here in Japan is leading edge in some ways. So I think in terms of your question around flows into Asia, there's likely to be a big tailwind. Everybody's incredibly underweight. Emerging markets are unappreciated. There's a peculiarly Western lens, I think, on a lot of what goes on here. People are far more concerned than they ought to be. The macro background is pretty strong, much stronger, in fact, than it is in the US and elsewhere. But from our point of view, it's not a case of allocating to a country or a region. We just try and find the companies that we think are most interesting. And in any region of the world, there's only a few companies that we think on a 10-year view can be reasonably predicted to be world-beating.
Stuart, thanks for sharing some of that outlook with us today. Great to chat. Baillie, Gifford partner Stuart Dunbar. We have more ahead on the Asia trade. This is Bloomberg. As we count down to the start of trade in Japan and South Korea, take a look as well at how commodities are faring. We have those continued expectations that we are inching closer to a peace deal on Ukraine. That seemed to be putting downward pressure on oil prices just a day ago, but looking pretty range-bound towards the 58 handle on U.S. crude futures for the moment. Really also about what we're seeing in Fed rate cut expectations, given this debate about the data with U.S. consumer confidence looking really weak. That's really cementing the expectations of what we see from the Fed in a couple of weeks from now. Gold looking pretty flat. We have more ahead on the Asia trade. This is Bloomberg. We have breaking news crossing the terminal in relation to obesity drugs. Now we're hearing that Medicare has negotiated a 71% discount on Novo's Ozempic and Wegovy. And of course, for context, we have heard from the likes of Bloomberg Intelligence how some of these drug sales for the likes of Eli Lilly, Novo Nordisk, they could fall $2 to $3 billion next year if we have this U.S. scenario of cutting some of these drug prices. So that could put pressure on those stocks as well. But taking a look at New Zealand assets, because we do have RBNZ decision that is due this morning, we are seeing stocks doing really well. Bonds are not really giving us that much direction for the moment. It's worth highlighting as well, the Kiwi dollar is the worst performing G10 so far this year. The expectations are for the central bank to cut 25 basis points, but then beyond that, how wide is it opening this door for future rate cuts? Let's bring in our Asia Pacific economy reporter, Swati Pandey. Swati, talk to us first about what your sense of the RBNZ messaging is going to look like for the first half of next year potentially, and how that might play into expectations of future rate cuts.
Yes, good morning to you. The RBNZ has already cut interest rates by 3 percentage points since they started the easing cycle last year. Today, the expectation is for 25 bips. It's very unlikely that they will try and do something bigger because that would really take away the impact, in the sense that if they go bigger, markets would assume that they are done. So they want to go in a smaller increment and probably keep the door open and keep their easing bias intact. Key to watch for the next 6 months would be where their OCR projection is, that is the official cash rate projection. It's kind of similar to the dot plot that the Fed releases when they do their quarterly outlook. And also the RBNZ would release their forecast for unemployment and economic growth. And those would be very key indicators for markets to understand where the RBNZ thinks monetary policy is headed.
The weakness we're seeing in the economy, partially to do with weak immigration and where property prices are trending. What is your assessment of how we are going to see these rate cuts working their way into those sectors of the economy as well?
So monetary policy transmission takes a long time to flow through the economy. We are seeing some very early signs of that transmission working through in the form of job advertisements as well. Inflation data was also strong for third quarter. A lot of it was temporary, and the RBNZ does not seem worried about inflation at this point. But there are some very nascent signs that property prices are picking up as well. So it does look like that stimulus would have an impact over time. Maybe 2026 is finally the year when New Zealand's economy starts showing some momentum. As far as immigration is concerned, that is a tough one. New Zealand is not seeing the flow of people into the country, but at the same time, New Zealanders are leaving their country and moving to Australia in huge numbers. We saw that trend kind of picking up last year, and it hasn't really stopped. Every time the data releases, we see that exodus continuing, and that is a worrying sign. So once New Zealand's economy picks up, shows momentum, unemployment rate falls, there is more opportunity in the labor market, maybe that is when that exodus would stop and New Zealand would become an attractive place for workers from overseas as well.
Swati, we'll watch the labour market in New Zealand as you suggest. Thank you so much. As we count down to the RBNZ decision, our Asia Pacific economy reporter Swati Pandey. Now on to the labour force in Japan. The leader of the country's largest labour union has urged Prime Minister Sanae Takaichi's government to do more to fight inflation. In an interview with Bloomberg, Rengo Chair Tomoko Yoshino said the goal is to ensure workers' wage gains outpace rising living costs. For more, let's bring in our Asia or North Asia government senior editor Brian Fowler in Tokyo for us. Brian, talk to us about these Rengo comments from Yoshino. What do they tell us about the trends in wages?
Good morning, Avril. So first of all, what does Rengo hope to achieve this year? It's important to look at that. It's set a target for broad wage gains for its group exceeding 5% and for small companies exceeding 6%. That's important because those are the exact same goals Rengo set a year ago as it began the process that culminated in March with the biggest wage gains in 34 years. So the fact that they're starting out with the same goals as a year ago that resulted in the biggest gains in 34 years tells us that wage growth momentum is very much intact. We don't know exactly, of course, what the results will be this year, but for now, at this point, it looks like Rengo is ambitious and thinks it can go for very generous gains.
Her comment on fighting inflation seems quite new. How significant is that? Is that a change that we're seeing in terms of the commentary coming out from the labor union?
Yeah, it's definitely very significant. So even with the big gains in nominal wages that we've seen, real wages have fallen for every month in the last 9 months. So that's a problem because households, even with these big wage gains they're getting, they still feel like they're losing to inflation. So what Yoshino now is saying to the Prime Minister is, look, we need broad help on this. So far, Takaichi has tried to solve the problem by throwing money at it. She's put money aside for subsidies, to lower the cost of utilities, to cut the gasoline taxes. But Yoshino is now saying it needs to be something much broader than that. Could start with something like, for example, addressing the yen. The weak yen is pushing up prices through imports. Start with that, and maybe that would help us help households feel like they're getting ahead.
To what extent is that actually going to move the needle for the December decision, right? Because we are hearing from a BOJ official that the weak yen might actually spur the central bank to move.
Yeah, exactly. So we had ex-BOJ official Kazuo Momma talking this morning saying that with the weak yen where it is and with economic data looking pretty robust of late, the chances for a December hike are pretty high. He's not ruling out that it could happen in January, but he's definitely saying that December should be looked at very closely. He's talking about the weekend. He's also said that there's no reason for the BOJ to wait because we've seen already these early signs on the wage front. Governor Ueda has said specifically that the BOJ wants to see the early signs on the wage talks. He doesn't need to wait till the end, but he wants to see how things look going into the negotiation process. We've already got those numbers now, so it's quite possible that Ueda will have enough data he needs, enough information to go ahead and press ahead with a rate hike on December 19th.
Brian, thank you so much. Great to chat. Our North Asia Government Senior Editor, Brian Fowler, in Tokyo for us. We have more ahead on the Asia trade. This is Bloomberg. Bloomberg has learned that the Chinese government has instructed the country's airlines to reduce flights to Japan through March next year. Sources tell Bloomberg that airlines were told to make the changes for now, suggesting the situation could change in line with diplomatic developments. The order came last week before President Trump's back-to-back phone calls with Prime Minister Sanae Takaichi and China's Xi Jinping. Travel from China to Japan had already slowed as tensions simmer over Takaichi's comments about Taiwan. For more on the outlook for travel in Asia, let's bring in Laura Houldsworth, Managing Director and Asia Pacific Vice President at Booking.com. Laura, great to see you. So first off, let's talk about what you're seeing in terms of tourism from China into Japan or incoming tourism to Japan overall. Are you seeing any shifts there based on these geopolitical developments?
Yeah, I think that Japan remains has a global appeal for many reasons. I think it's interesting to see now what with China and Japan. But, honestly, travel is impacted by a wide range of factors consistently, whether that's visa policies, climate changes, and, of course, the geopolitical situations. And sometimes these temporary fluxes do make a difference, but we're not seeing it honestly yet. China is still in the top 5 searches for us at Booking.com, but it is the Lunar New Year period coming up in February when we would start to see the bookings coming in the next few weeks, and that I think will be a bit more telling. But for now, no major impact, and Japan still remains certainly has its worldwide appeal.
To your point about this worldwide appeal for Japan, I think one of the conversations are about over-tourism in the country. How do you see it as sort of spreading the load to perhaps less popular areas of the country?
It's very critical, and we know the Japan government have inbound strategy to make sure we do diversify the population and the tourist population across the country, and we are here to try and support that. And we are seeing more. I mean, of course, the typical places are topping the searches: Tokyo, Osaka, Kyoto, but we are seeing now much more searches for those regional destinations: Sapporo, Yokohama, Naha, Hakone. So this is something that we will start to see more and more. And Japan, this worldwide appeal is about the authentic culture and the uniqueness of Japan. And so people are searching for that and searching for those unique destinations. So I think we will continue to see that spread across the country, and we certainly want to help. And AI is helping, because we know technology is enabling people to search in natural language for something very different. And that's where all these regional types of destinations are showing. And we're excited to see how that continues to grow for Japan.
When it comes to regional destinations, I wonder, I mean, for your assessment of what you're seeing between China and Japan for the moment, you think that is pretty limited. Maybe you're not seeing early signs of that. But what are you seeing on mainland China in terms of travel trends? Is Booking looking and making a larger push into that market, which of course is being dominated by the local travel players?
Yes, for Booking.com, we certainly support the Chinese growth of travel, whether that's domestic, inbound or outbound. Of course, we have peers in the industry, and there are certain dominant players in certain markets, and China is particularly one of those. But we will continue to see the rise of travel. I mean, we've seen as borders have opened over the last couple of years and infrastructure has really returned, then the China travellers, which has been very heavily domestic for the last few years, is starting to go much more broadly, and certainly across Asia Pacific. I think we will continue to see that, but again, it's influenced by many factors, geopolitical being just one of them. Visa situations, visa policies open doors to many different destinations. China itself has opened the visa policy to much more destinations for inbound. So we will see impact of this, I think, over the course of the next few months, next couple of years. But China remains obviously a force in travel.
Can you share a bit more on what those potential plans might look like, given how China holds this immense opportunity?
Yes, I mean, for China travellers, I mean, the whole world was waiting for a few years for the China travellers to come back, because there are so many and so many countries have been reliant on them. But I think now that travel generally is appealing, and it's become much more of a necessity, we're seeing for travellers. So it's for people in general, people are looking to travel much more, and it's not just the Chinese, which is just a very large population. We're also seeing India travellers going out much more, countries opening up visas also to different markets. So I think we will continue to see more and more opportunities for travellers. And what's really interesting, we're seeing that people are looking for these self-curated trips, gone are the traditional, I know where I need to go, or I know where I want to go, but now looking for something really very unique. And again, Japan holds this kind of worldwide appeal for travellers who are looking for authentic culture, unique and exquisite cuisines, natural landscapes, this self-care component with onsens and wellness. So I think we will continue to see Japan hold its worldwide appeal. I mean, I'm here now and enjoying it very much. And also, obviously, the Chinese travellers are looking to go wherever they can in the region and globally as well.
For the Chinese market, though, specifically, how would that affect Booking's plans for that market?
The Chinese traveller, I mean, the Chinese tourism particularly, I mean, has been very heavily domestic, and we'll support that. We also looking to spread travellers beyond the traditional cities. And so our plans will continue to be to support travellers wherever they want to go and to help them look for those unique and authentic experiences, where that's domestically, into China, out of China, and the same for all the countries across Asia Pacific.
When you're looking at the Chinese traveller, though, I think part of the debate is also beyond just moving into international travel. Is it high value spending that we're seeing? What are you seeing in terms of trends?
Yes, absolutely. There is high value travel is continuing. So while economic pressures continue around the world, we do see the luxury sector continuing to grow. And this is also, I think, where people are putting a priority on spend on travel. You know, we've seen also this shift from people taking milestone trips, whether it's honeymoons or big birthdays, to look for that really big trip. Actually, now they're saying it's important to do that now, and wanting to spend on the discretionary spend on travel, and it became really a priority. So I do see that the luxuries end will continue to grow, but also people are taking more frequent, shorter trips. So also leveraging the opportunity to see more different places. We've seen RevPAR, so revenue per room rate, growing by 40% year over year across the region. And on average, the whole region now is about 10% above where it was in 2019. So we do see the continued growth of travel and the economic impact of that.
Laura, really good to chat. Thanks so much. Laura Houldsworth is Managing Director and Asia Pacific Vice President at Booking.com. Now, we also have some other stocks that we're watching in the session today, keeping an eye on tourism, retail-related stocks when trade begins in Japan shortly. Among those are Shiseido and department store operator Isetan Mitsukoshi, which are traditionally popular with Chinese tourists. This is Bloomberg. Some auto industry analysts have told Bloomberg that electronic door handles are proving to be a safety hazard, leading in some cases to deadly outcomes. The feature, pioneered by Tesla, has been adopted by many other automakers, and some are now redesigning their electronic devices so they can be manually operated after a crash or fire. For more on today's Big Take, let's bring in auto reporter Keith Norton. Keith, we're talking about auto doors now, electronic doors. Why is this an issue?
Yeah, you know, Tesla kind of introduced these about 15 years ago on their Model S, the sort of flush door handles, very sleek, aerodynamic, very futuristic. And they became kind of the coin of the realm for electric vehicles, and even have spread to, you know, gas-powered vehicles, because they sort of speak of a luxury, frictionless aesthetic. But it turns out they're also dangerous. If you lose power to them, if the battery that powers both the interior and exterior doors don't work, then suddenly you can become trapped inside or outside of the car. And that has had some disastrous and even deadly consequences.
So how are perhaps some of these other EV players then looking to the Tesla experience and trying to make sure that doesn't become a problem for them as well?
Right. So, you know, what has to happen and what is starting to happen is these electric doors are being redesigned so that they become more intuitive. In some cases, on the Ford Mustang Mach-E and BMW models and Lexus models, they have interior door handles that are kind of an all-in-one solution. If you tug on them lightly, the door opens electrically. If there is no electricity and you pull harder on the same handle, then the door opens manually. But unfortunately, some of the other designs, Tesla, for example, some of its back seat handles, the manual release handle is hidden under floor mats or inside door map pockets. They're very hard to find. And in an emergency, it can be impossible to find. And that's caused some of the tragedies.
Very unfortunate incidents there, Keith. Thanks for bringing us today's big take as we look to door safety when it comes to EVs. Bloomberg Auto reporter Keith Norton. Now, shifting gears and looking at the latest from the corporate front, Bloomberg has learned that Warner Brothers Discovery has asked potential buyers to submit new sweetened offers after getting an initial round of bids. Sources say the parent of HBO and CNN has asked for the improved offers by December 1st. Paramount, Skydance and Comcast, as well as Netflix, are looking to buy some or all of the company. TSMC has sued a former executive who left to join Intel, alleging a high risk he leaked trade secrets to his new employer. The Taiwanese chipmaker filed the lawsuit against Lo Wen-jen, a former senior vice president, citing a non-compete agreement he had signed. TSMC says that when Lo departed in July, he failed to disclose his exit interview that he planned to work for Intel. JD.com has denied it's looking to raise at least $1 billion through an equity-linked bond sale tied to its health unit. Sources have told Bloomberg that JD is sounding out investor interest in bonds exchangeable into shares of its Hong Kong-listed online healthcare arm. Such a move would mark the latest in a wave of debt offerings by Chinese e-commerce companies. And here are some of the stocks to watch when markets open in Seoul. Samsung, as analysts say, Apple is poised to retake its crown as the world's largest smartphone maker for the first time in more than a decade. Counterpoint Research projects iPhone shipments will grow 10% this year, driven by the successful debut of a new series and a wave of consumer upgrades. Of course, when it comes to tech, it's also about AI as we continue seeing these differentiation among the Mag 7s and the developments related to processors. For the moment, given the Fed rate cut expectations, we're pointing to upside in Japan. Markets open next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. We could see some upside in Asian trading today after the gains that we saw on Wall Street. The narrative around the Fed changing as Kevin Hassett has emerged as a frontrunner to become the next Fed chair. We could see a more dovish Fed. And of course, at the same time, we're following what's happening here across Asia. We are seeing New Zealand stocks at fresh record highs. We are expecting the RBNZ to cut rates today.
Yeah. The stocks at fresh record highs. Also keep in mind how when it comes to the cross Aussie versus the Kiwi, we are approaching those multi-year highs or hovering near those levels. So there are, of course, FX implications amid all this as well. But Shery, we are looking at the open in Japan.
Yeah, we're looking at the open in Japan, and we could see some upside in early Asia trading. And you're seeing the Nikkei gaining 0.7%, and the Topix also gaining as much. The Japanese yen holding at that 156 level against the U.S. dollar. We continue to see verbal intervention from policymakers trying to support the currency. The latest one was for Growth Minister Takaichi saying that the government is watching currency movements. We're also watching the JGB yield, the 5-year yield at the highest level since 2008. Take a look at how the Kospi is also coming online because we have seen the first gain in 3 days already with that risk-on sentiment spreading across Asia. The Korean won has also strengthened, and we are expecting the Bank of Korea to hold rates steady in its decision on Thursday. Financial stability, a key concern.
Yeah, and we are seeing those tech plays certainly in the Asia Pacific. The debate also continues on about AI developments, who the continued front runners are going to be, especially when it comes to the US hyperscalers and those that are building out things, the picks and shovels, as some of our analysts have been speaking about in the past hour. And certainly, given what we're seeing in this continued bounce in tech names, might the AI rally continue driving stocks? Is that a more important factor when it comes to the continued gains in US equities, even as we keep in mind what we're seeing from the US economy? Things are looking weak, right? It seems like we're back to bad news is good news. You look at the data that we got in the past 24 hours or so. US consumer confidence, that is really a pain point, lowest in 7 months. And then you think about as well, even before the longest ever US government shutdown, how consumer fatigue in terms of retail sales numbers, they seem to be setting in. And then amid all this, core PPI seem to be keeping things under control in terms of allowing investors to bet on these continued Fed rate cuts. So we are about 80% when it comes to the expectations for a rate cut come December. Looking at the yield on the 10-year, which of course dipped below the 4% handle in the past session, driven by those expectations that we are going to see Kevin Hassett taking over from Jerome Powell as Fed chair. We know those dovish expectations have been seeping into the market. Again, the backdrop is about Fed independence. Those debates continue. We are pointing flat when it comes to S&P futures, and the tick up also that we're seeing in U.S. crude is interesting. Given what we're hearing from Trump, it sounds like we are moving closer towards a peace deal with Ukraine, Shery.
Yeah, we're following President Trump's comments aboard Air Force One at the moment, saying that it's getting close to a deal and they're making progress with Russia and Ukraine. He's speaking to reporters on Air Force One, saying that they're working out security guarantees with Europe. President Trump saying that they'll see what happens with the Ukraine deal deadline, which of course is this week. President Trump saying that he can imagine Witkoff is also speaking to Ukraine at the moment. Of course, is a White House Special Envoy, Steve Witkoff, who has been speaking to his Russian counterpart in the last few days. President Trump saying that Witkoff coaching Russia is a standard thing. So you can hear President Trump talking about the latest developments on the Russia-Ukraine plan. Remember, that was a 28-point plan put forth by the United States. There have been some concerns about whether or not this reflected Ukraine's stance and what the Europeans were going to do with this deal as well. We're hearing from President Trump also talking about not wanting to extend healthcare subsidies. We continue to watch the latest developments within the United States when it comes to domestic economics. President Trump saying that they don't want to extend healthcare subsidies. They're looking for alternatives on healthcare. We'll continue to watch the pharma sector in the United States as well, Avril.
Shery, another sector they were watching is Chinese tech after Alibaba's earnings. Its ADRs fell after its core China e-commerce business recorded a slump in second quarter profit amid this discounting war with its rival Meituan. And those declines came with trading volumes double the 30-day average. So this profit pinch came despite better than projected growth in its cloud business. That seems to be continuing to dog sentiment for the stock. Let's bring in our China correspondent, Min Min Lo, in Hong Kong for us. So, Min Min, talk us through what we're seeing in the Alibaba scorecard and the extent in which its AI spending paying off, helping the cloud business, is helping to offset what we're seeing in e-commerce.
Yes, you're right. Actually, its investment into AI has indeed been paying off because the biggest growth in revenue was coming from its cloud computing segment. That's also the division that houses the Qwen AI model as well. That was 34% increase in revenue from that segment. E-commerce doing reasonably well. We're talking about 16% gain on revenue, and that overall the total revenue was up 5%, which was better than expected. And you can see from this chart that a big part of the revenue was really driven by cloud. But the bad news is that net income took a huge hit. We're talking about big plunge in net income. A big part of it was because of the hundreds of billions of yuan that Alibaba had spent in subsidies for merchants and for consumers, these discounts, in order to fight off the price competition with the likes of JD.com and Meituan. We're talking about the quick delivery, the so-called Taobao Shangou, a quick delivery platform seeing EBITDA slumped by about 70%, which one analyst said is, quote, a horrible loss. So I think that was the main pain point, because if you look at total free cash flow, that came in negative for 2 consecutive quarters now. It's the first time we saw that since it listed in 2014, and that is why investors are punishing the stock. It closed about 2.3% lower overnight at the US session.
So what more can we expect from AI spending from Alibaba?
Yes, Alibaba is still, the CEO interestingly saying that he's not concerned about AI, the AI bubble. Over the next 3 years, the company had pledged to invest about 380 billion yuan in AI spending. And this is a huge amount. If you compare that to Tencent, they're only investing 1.8 billion yuan. So the difference in scale is huge. And Alibaba is saying that they still will continue to be aggressive in their investment to keep up with the fast changing environment, they say. And the ambitions of Alibaba is really huge as well, right? Because it wants to be this full stack AI service provider, from the infrastructure, the data centers, to the chips that are used to build them, to the AI model and the applications on top of it. They want to provide the whole suite of services. And with the latest release of that Quinn AI model, that revamped app was released a couple of weeks ago, which saw very strong download rates. In fact, it's the fastest rollout of any AI app in China, 10 million downloads within the first 4 days. And the company wants to incorporate that, turn that into an AI agent in the future, so that the app can help you make a travel booking, to shop on Taobao for you. You know, it would have mapping functions, education functions, and really expanding it to be an all-encompassing app. So, of course, the competition is intense, right? Because Tencent has similar ambitions for WeChat, and currently another market leader is ByteDance's Doubao, which is a leading chatbot in China as well. So a lot will depend on whether Alibaba can continue to show that strong growth in its cloud revenue.
Also wonder what this means for the pressure it's putting in e-commerce that it needs to perform. Let's bring in Bloomberg Intelligence senior analyst Catherine Lim on this. So, Catherine, Min has just run us through some of what's at stake, especially when it comes to AI. Talk to us about what you saw in e-commerce. How promising do things look there?
Right. I guess, I echo what Min has highlighted. I get the 76% e-commerce profit drops, and you're looking at a single-digit margins for the business, which still contributes bulk of Alibaba's profit. It does raise the question on what is the new normal for Alibaba going forward, particularly since it is now into quick commerce, and the playing field right now is really between them and Meituan. Question is really, will they be able to actually sustain this edge if they actually start to cut back on subsidies, which we all know, and as Min has highlighted, that was really driving the revenue growth that we have seen, essentially the 60% quick commerce revenue growth. So there are still uncertainties, I would say, which does mean that the visibility for the e-commerce business for Alibaba still remains fairly murky.
What does this mean for Meituan's results in 2 days?
Right. Meituan, the good is that the company will be reporting losses, and, they will be together with JD.com, 2 of the companies that have sank into losses, for the last quarter ended September. So it does mean like, the trajectory ahead, given what Alibaba has highlighted, that, it is at its peak of its investment. It's going to focus on efficiency, user experience. I do think that, it is a little clearer for Meituan that the trajectory is on the upwards. But let's see what the company says on Friday. If we do not see further retaliation measures coming through from the company itself, I do think that, overall profitability could be edging up. Question is, again, what is the new normal?
What are you seeing in terms of margins more specifically, to your point earlier, Kat? And how do you think things are shaping up versus some of the other e-commerce rivals?
Right. Well, I don't think, for Alibaba specifically, if you actually look at their China e-commerce profitability, which hovers around, your 25-30% in the past, I doubt they're going to actually get to that, over the next year or into the new fiscal year of 2027 ending March. What is, again, the new normal itself? My best guess right now, I do think that, it will at least be a third down. We'll have to actually see what the developments are over the course of the next 12 months. As the company has highlighted, it is still a very fluid market. Let's not forget that in the backdrop is that consumer sentiment isn't the most robust in China right now, and we'll really have to see whether that picks up to actually support full price spending or really spending without subsidies and perks.
Bloomberg's Catherine Lim and Mimi Lo there with the latest on Alibaba and Meituan, of course, results to come in the next 2 days. This is Bloomberg. Take a look at how Asian markets are trading at the moment. We are seeing broad upside for the Nikkei and gaining ground as we continue to see weakness on the Japanese yen, trading at that 156 level against the dollar. We have seen Growth Minister Takaichi, the latest policymaker, to talk about these rapid currency moves. ANZ saying the verbal intervention alone, though, is not going to be enough to prop up the currency. It's all remains to do with the Fed, the Bank of Japan, Japan's fiscal outlook. Morgan Stanley strategists think that the yen will appreciate nearly 10% against the greenback in the coming months because of the difference in this rate trajectory. In the meantime, the Kospi also gaining 0.6% as we continue to watch those tech stocks. Apple expected to retake its crown as the world's largest smartphone maker past Samsung, Avril. ASX 200 gaining 1%.
To your point, Shery, about it all being about the Fed, those rate cut expectations really giving the mood music to equities. Manulife Investment Management MD and Senior Portfolio Manager Marc Franklin joins us now. So, Marc, good to see you.
Morning.
When it comes to the Federal Reserve, there are divisions, perhaps the most divided Fed we've seen in a long time, but investors seem to have made up their mind already.
That's right. We've had a real divergence of opinion by Fed speakers when they've been talking to the market in the last few weeks. But just in the last few days, you've had Williams and one or two other members who are quite close to Powell indicate that they're comfortable with the prospect of a rate cut in December. So the odds have shifted from as low as 20% up to 70% plus. And that's provided some solace to equity markets who are starting to get worried about a slightly more hawkish turn post the previous meeting. And of course, we're still seeing 3 cuts for next year priced in as well. And so when you put that all together, we have relatively loose fiscal policy, the potential for easing monetary policy, and that creates, in a nutshell, easing financial conditions.
So how would you position across U.S. assets? We saw treasuries gaining, the dollar is soft, stocks are doing well. How are you allotting?
Yeah, so for a brief moment, markets behave almost as if we're in a Goldilocks macro regime. Now, that doesn't necessarily last, but in that environment, anything that benefits from easier financial conditions or easing lending costs will benefit. So treasuries, as you rightly point out, have seen a bit of a bid. And then within equities, we like the idea of a rotation under the hood into year end. So profit taking in the year-to-date winners, particularly the more speculative names, and rotation into the laggards, the more discounted parts of the market, or those businesses which are somewhat levered on their balance sheets because those borrowing costs, the expected borrowing costs, start to come down.
Talking about easy monetary policy really kicking up those stocks. Kiwi stocks, fresh record highs. We are expecting a rate cut from the RBNZ. How are we positioning in the rest of the Asian markets with the BOK expected to decide tomorrow as well?
It's a bit of a mirror image of what we're thinking about in terms of US equity markets. We're thinking about rotation away from those powerful winners year to date into some of those more laggard markets. And that can be on a geographical basis. It can be on a sector base as well. So in that sense, we're somewhat more cautious on markets such as Australian equities, that they became relatively fully valued. And we've rotated into markets which have lagged somewhat, or sectors which have lagged somewhat on a more pan-Asian basis.
What do you think of the Japanese market? Because the yen continues to weaken and the rate differentials narrative continues to pressure the currency right now. At the same time, Morgan Stanley coming out with the idea that we might see 10% gains into next year.
Yeah, so just in the last few days, we saw a ramp up in verbal intervention by the Ministry of Finance, the Bank of Japan officials. And then just as the yen was accelerating with added velocity towards that 158 level against the dollar, we saw a bit of a snapback into the 156 handle area. Now, overnight, there's been a little bit of a reversal. Our view would be that there is the potential in the very short term for some further moderation in the yen. But our fair value models do anticipate that the dollar yen will shift eventually back towards the 140s range. And so as a result, we think on a medium term horizon, it makes sense to effectively, if you're a Japanese investor, a yen-based investor, to start building your hedges of dollar back into yen as you progress through the final weeks of the year.
What about the currencies of markets that have done pretty well this year, including the Korean won, the Taiwan dollar? Why are we seeing that bout of weakness? Do you think that continues into next year as well? How dependent is that going to be on stock market flows?
Well, to some extent, you can think of the Taiwan dollar in particular as a high-quality currency. It runs a very large current account surplus. And as I mentioned earlier, the potential for rotation away from year-to-date winners or the highest quality names in towards the laggards, the more cyclical names, that can also be proxied by what we see in the currency environment, where you shift away from the large current account surplus currencies into the current account deficit currencies.
The rupee around record lows. Is the India market a good diversifier?
It's a great question. We think of India as a core anchoring position within Asian portfolios, but occasionally also serves as a bit of an ATM, particularly when investors look to move exposure into those markets that are more discounted, that might see a bit of a catalyst or a trigger. And we saw that earlier this year, particularly after the elections in Korea, a very powerful rally on a very discounted market. And clearly some of that added exposure that investors made into Korea was probably funded from taking some exposure out of their overweights in India as well. So India, to some extent, is driven by the extent to which investors see other opportunities in the region, or in a more murky growth outlook, the secular domestic growth drivers of India provide some comfort for investors, and it's seen as a bit of a core stabilising holding in portfolios.
The thing is, there isn't really much in terms of AI to play India, though. Do you see that as perhaps affecting your view?
It's a good question. I think for the tech, the outsourcing names in India, there's the sense that maybe some of those business models are a bit legacy in terms of the push towards AI, and what does that do for the outsourcing model? And so that has been a bit of a headwind for the Indian equity market. But at the same time as well, the secular shifts away from globalization, the stresses that places on global trade activity will benefit more domestically oriented economies. So I think over a medium-term horizon, India still looks relatively fundamentally well set.
Marc, good to chat. Thank you. Manulife Investment Management MD and Senior Portfolio Manager Marc Franklin. We have more ahead on the Asia trade. This is Bloomberg.
President Trump says his envoy Steve Witkoff will meet Russia's Vladimir Putin next week in Moscow in the push for a Ukraine ceasefire agreement. Let's bring in Bloomberg's John Herskovitz. And John, President Trump talking about tremendous progress. What's the state of play right now?
Sure. We're seeing two things happening. The state of diplomacy has really speeded up. We have envoys, top envoys from Ukraine, Russia, and the U.S. having talks. but the actual progress still is elusive. The basic things which have separated the countries and made it impossible to get a deal are still there. Russia is looking for its maximalist demands, that Ukraine abandon hopes of joining NATO, that it limits the size of its military, and it seizes territory, including portions of the Donbass region, which Russia doesn't occupy. Ukraine just sees these as non-starters. These are things which they will not agree to. So the basics of what are keeping the two countries apart haven't changed, but the diplomacy is going on very fast, quite furious, and it has really picked up in the past few days.
John, does Ukraine necessarily have a choice in all this, though?
President Zelenskiy is in an enormous bind. He's seeing, as these talks are going on, that Russia is conducting missile and drone strikes in his country. He is facing the prospect of losing support from the U.S. diplomatically, economically, and militarily. He has to try to maintain support with the EU to get the economic backing and the military supplies that he needs. And he's facing domestic crises as well, including a corruption scandal that's eating at his government. There are enormous pressures on him. The international legitimacy, the domestic legitimacy are all it's like a vice squeezing him. So he has faced these for years. This is not new, but the pressure is there and it just keeps on mounting.
How much is President Trump being squeezed right now? How much is at stake for him, given that he's been talking about a deal for the longest time?
Yeah, we've seen the Trump speaking about this deal for a long time, but he goes hot and cold with these things. He imposes deadlines. The deadlines pass. We've seen many deadlines over the past several months. So for Trump, it's a point of focus now, but we've seen his attention wane. When things don't go well, he'll move on to other issues. So it's Ukraine, Russia runs hot and cold. This is something that Trump said during the campaign he'd be able to solve quickly. I think it was like in 24 hours. And here we are several months into the presidency, and things are just as difficult now as they were back then.
John, thanks very much. Bloomberg's John Herskovitz with the latest on this potential Ukraine peace deal. Now, let's take a look at how Europe futures are faring at the start. As we saw that positive momentum trickling through, futures are pointing to further upside. Of course, keeping watch on the pound as well, with an eye on the UK budget that is to come and how the inflation goals could be at risk for the moment. We are assessing what Rachel Reeves is expected to do when it comes to the minimum wage hike. We have more ahead on the Asia trade. This is Bloomberg.
Right, we are awaiting Australia's CPI numbers right now. This would be the new monthly CPI numbers. The consumer price index, usually we've had partial indicators published since 2022. The expectation right now is that the CPI year on year will have slowed moderately, but still stayed above the 2 to 3% range from the Reserve Bank. This is according to Bloomberg Economics, which expects the central bank to resume cutting rates in the first quarter of 2026. We're getting the numbers right now, and headline inflation year on year accelerating 3.8%, coming in above economists' expectations of 3.6% for the month of October. Month on month, no change, 0%. And this, of course, as we continue to watch the trajectory for the RBA, which a modest slowdown would not necessarily change. But as you can see, the inflation number for the headline CPI year on year has surprised to the upside.
Shery, you talk about this number being a new one. I think it'll take a while for RBA policymakers to get used to it. Here's a look across the Asian FX space. We're tracking moves, of course, in the Aussie dollar after the inflation print, and then Kiwi as well, ahead of the RBNZ rate decision due in the next hour. If you're watching Aussie versus Kiwi, we are around multi-year highs. Now, the Bloomberg Dollar Spot Index, that has lost ground, falling the most since mid-September in the US session, although we look like we are actually extending losses for the moment. All this against the backdrop of Bloomberg reporting that White House Economic Council Director Kevin Hassett is emerging as the frontrunner for the Fed's top job. For more analysis, let's bring in Bloomberg's chief FX and rates correspondent, Ruth Carson. So, Ruth, we have the chatter about Hassett being next in line, and then we have the really bad US data. Talk to us about this fresh bout of bearishness on the greenback.
If there is one way to describe dollar trading at the moment, it's choppy. So lots of factors actually influencing the dollar's direction. Obviously, overnight, we had that report about Hassett being a front runner for the Fed chair job. Now, there were already concerns around Fed independence. We know that Hassett is very close to Trump. So traders are certainly seeing it as a bearish signal for the dollar. And in fact, if we look at the rate story, it's similar. It's bullish bonds, it's bullish treasuries. And we saw the 10-year, for example, actually dropping below 4% overnight. And again, that's a reflection of expectations of further Fed easing. So yes, definitely watch the dollar in this space.
And we're also watching the Japanese yen on the other side of that trade, right? Because still pretty range bound despite the fact that we have seen a dollar slump. Does that mean that the likelihood for a next rate hike could be in December, actually?
Yeah, it's a debate that is definitely ripping across Asian trading desks in particular. Will the BOJ hike or not? A lot of it does come down to the dollar too, and the US side of the equation. But if we focus on Japan specifically, we've had commentary obviously from currency officials warning about the weak yen, which obviously exacerbates inflationary pressures from offshore imported inflation. And yes, investors are sort of reading the tea leaves, so to speak, talking to traders across markets. There is an expectation that a BOJ could hike. But then if we look at Takaichi's pro-stimulus stance, that's also up for debate as to whether or not the BOJ will move. So definitely, again, another key currency to watch, considering it's the third most traded currency in the world today.
Ruth, looking at our WCRS function in the bottom rung among G10s, it's not the yen, it's the Kiwi dollar for the year. You're watching what traders are doing in terms of positioning ahead of the decision that's due in, 30 minutes from now? What are you seeing in terms of positioning?
I think it's really important to remember that when it comes to the Kiwi, it is linked to a very small, open economy, like its Australian neighbour, except even more vulnerable, if we can put it that way. So not only is the Kiwi beholden to rate differentials, we obviously have stresses from China as well, and also all the trade fluctuations that we've seen with headlines. So yes, it is the worst performing G10 currency in the world year to date. Is there more pressure ahead? Absolutely, especially if there's no resolution to the trade issues that we're seeing, and also the RBNZ's path going forward.
Bloomberg's chief FX and rates correspondent Ruth Carson there with the latest on the FX markets as we're keeping our eyes on the Aussie dollar. Look at it go, because we're seeing some strength against the greenback, especially after we saw that CPI number beat estimates. And the ASX 200, in fact, curbing some of those earlier gains. The Aussie dollar has traded pretty flat in the past year to date. We're talking around that 64.80 level, which continues until today. And this, as we are watching other markets like Japan, every sector in the green, led by utilities and communication services. The Japanese yen holding at that 156 level against the greenback. And as we talked with Ruth, really not a lot of movement, but perhaps more people expecting a rate hike in December, given the pressure on the currency. We continue to watch also the wage trend here in Japan, because, of course, that will be key for the BOJ's decision. The leader of Japan's largest labor union has urged Prime Minister Takaichi's government to do more to fight inflation. In an interview with Bloomberg, Rengo Chair Tomoko Yoshino said the goal is to ensure workers' wage gains outpace rising living costs. For more, let's bring in our Tokyo economy and government reporter Erika Yokoyama. And Erika, the annual wage negotiations in the spring, so crucial for what the BOJ might do next.
Yeah, correct. So, the annual wage negotiation will officially kick off later this week on Friday, with the Rengo announcing its finalized target and policy. And last year, as you said, they achieved 5% gain, and this year seeking it again. So like BOJ, of course, and Takaichi, and also household are closely watching whether the momentum can be sustained. And in terms of BOJ, this is important because, of course, wage is a key element for the banks to proceed with the tightening process. And especially the Ueda said after the decision in October that he's closely watching the initial momentum of Shunto negotiation. Then if he finds any sign I think the bank can move forward. And towards the end of the year and New Year's, there are lots of opportunity for the banks to gauge these kind of initial momentum, and companies should soon announce the pay offers for the next round, or the smaller unions like the industry-specific unions are announcing their targets. So we can probably see some initial momentum from both labor side and the employer side.
Erika, what about how Rengo's chair views the environment for wage growth?
Sure. Of course, she's a union leader, so she's forward-looking, expecting for continuity. But at the same time, she was pretty much cautious as well in the interview yesterday. She said there is some risk in the economy that didn't exist last year. For example, she said Trump tariff is a big concern. And one survey actually showed that 1/3 of the Japanese companies are seeing a smaller profit in this fiscal year due to U.S. tariffs. And, especially Yoshino was a bit worried about automakers hitting with these tariffs quite hard. And, automaker has been the industry to lead the negotiations, so probably they're going to set some tone. And Yoshino was also concerned about the weekend-driven inflation as it squeezed profit for a lot of importers and SME, smaller companies across the company. And she was also talking about the chronic labor shortages hitting the Japanese firms. It's raising the concerns about the business continuity as well. Despite all these challenges, but still Yoshino was pretty much hopeful for the wage hike this year. As she says, this is a turning point, crucial year. The company needs to eke out some compensation for workers.
It's interesting that you said earlier that the BOJ wants to gauge the initial momentum of wage negotiations, right? Mm-hmm. But they do have a decision in December. Will that be enough time for them to gauge it?
It's really good question and probably difficult to tell at this stage, but there are several opportunity for the banks to know the initial momentum. That the one I already said, the company is going to announce some pay deals, especially like a big farm typically. And also we also have a Tankan survey in the mid-months. So that's probably helpful to gauge how companies are seeing the business climate at the moment. Then that's towards the end of the year before the December hike. Then once the new year starts, the BOJ will have a branch managers meeting where the bank can gauge how the regional businesses are feeling about the business climate. And, regional businesses are typically struggling to do the wage hike due to a lot of challenges. So if the signs from these regional bank meetings are convincing enough, I think there's another reason to consider BOJ, the rate hike in January. So there are probably some the motivation for the BOJ to wait and see as well. Well, but let's see how it goes.
Half and half at this point.
Yeah.
Erika, thanks so much for weighing in on all this. Our Tokyo economy and government reporter, Erika Yokoyama. Here are some top corporate stories we're tracking. Singapore's GIC and Brookfield Asset Management are said to be jointly exploring a potential takeover of Sydney-listed National Storage REIT. Sources say the funds have been talking with banks about financing as they consider an offer. National Storage operates more than 270 storage centres across Australia and New Zealand. Bloomberg has learned that Warner Brothers Discovery has asked potential buyers to submit new sweetened offers after getting an initial round of bids. Sources say the parent of HBO and CNN has asked for the improved offers by December 1st. Paramount, Skydance, Comcast and Netflix are looking to buy some or all of the company. TSMC has sued a former executive who left to join Intel, alleging a high risk he leaked trade secrets to his new employer. The Taiwanese chipmaker filed the lawsuit against Lo Wen-jen, a former senior vice president, citing a non-compete agreement he had signed. TSMC says that when Lo departed in July, he failed to disclose in his exit interview that he planned to work for Intel. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at some tourism and retail-related stocks across Japan. We're seeing a little bit of a mixed picture, but remember, it's an update broadly here in Asia. We have heard from the Chinese government that they've instructed the country's airlines to reduce the number of flights to Japan through March 2026. The diplomatic spat continuing over Taiwan between Beijing and Tokyo. So travel from China to Japan has already dipped. So we'll continue to watch these tourism, retail-related stocks across this country. In the meantime, Korean retailers and consumer shares are drawing renewed interest given this diplomatic spat between China and Japan. For more, let's bring in Asia stocks reporter Yoo Kyung Lee from Seoul. Yoo Kyung, so I guess the rivals in Korea are doing better.
Yeah, that's absolutely right. So I was looking at this index of Korean retailers and some other distribution channels, and the index is set for the best gain in 2 decades. And remember, still, some of the analysts and investors are saying that these retailers, like department stores, are still cheap if you look at their valuations and price to earnings ratio. So some of the latest catalyst is coming from this diplomatic tensions between China and Japan, South Korea's two Asian neighbors. Analysts are expecting some kind of a growth in the inflows and foreign capital to South Korea, especially from China, after Beijing issued travel warnings to a citizen against going to Japan, and also it ordered airlines to reduce flights to Japan. So where all these Chinese travelers could go, it could be South Korea. So what analysts are expecting is something like what Japanese department store in 2022, when weak yen lured a lot of Chinese tourists to Japan, and they spent a lot at the department store that led to the re-rating of the Japanese department store. Now this time, it is South Korean department stores can see the increase in their revenues coming from Chinese and foreign tourists as this diplomatic tension diplomatic tension between China and Japan has flared earlier this month.
What are the risks to the view, Yoo Kyung, that the Korean retailer stocks benefit from this spat between China and Japan?
Yeah, so with this geopolitical tensions, these stocks definitely could see increased volatility as this geopolitical noise are there. There's also a risk of a potential truce between China and Japan, although the investors I've spoken to don't seem to see any potential truce coming in the near term, but we never know. So that could also shift bets if there's like a truce between China and Japan. But still, because the valuations are really cheap and there seems to be more upside, and this increase in foreign spending at Korean retailers could have a lasting multi-year earnings impact, and that seems to be drawing a lot of bullish bets from the investors at the moment.
Yoo Kyung, thanks very much. Our Asia stocks reporter Yoo Kyung Lee. Now, China's reaction to Japan's comments on Taiwan has been intense. It's involved death threats, import bans, even hints of military action. But Bloomberg Opinion columnist Gerard Reddy says the latest flare-up is part of a larger cycle of tensions between the two countries, with Beijing using a mix of tactics to redefine norms, establish its position. Gerard joins us now with more. So, Gerard, put things in perspective for us. Is what we're seeing this time around any different?
I personally don't think it is. I think the question that everybody is asking at the moment is, what is it that Takaichi has said that has caused such this, this intense level of reaction from Beijing? But I think if you look at the pattern of relations between the two countries, especially over the last 20, 30, 40 years, shall we say, you often see these cyclical flare-ups where something is basically, some sort of slight is taken up, and then that's used more as an excuse to ratchet tensions up rather than actually being the cause of that. You can only have to look back a couple of years to the issue of Japan's release of treated water from the Fukushima nuclear plant. That caused a severe chill in relations with Japan at the time. And it was completely, unscientific, shall we say. It wasn't backed up by any actual change in the reality on the ground. It was used more of an excuse, shall we say. And that led to, you saw similar anti-Japanese boycotts of Japanese brands, and mild protest and strong protest from officials at the time. I think what you're seeing now is a very similar pattern to that. And you only have to go back a couple of years before that to see these type of issues always seem to flare up, and they always seem to follow the same cycle.
Yeah, and it's a very convenient time right now, Gerard, right? I mean, the Chinese economy is still not in full recovery at a time when even the Japanese are not very happy with the cost of living. How long do these spats normally last?
That's a good question. It can certainly last years. I would certainly say that in this case, I wouldn't expect to see any climb down from Prime Minister Takaichi. And that's going to make it difficult now, I think, for Beijing to find an off-ramp, to find some way to de-escalate. Often what you'll see happen is we're at the moment now where there are strongly worded complaints and letters being sent to the UN and diplomatic meetings and that kind of thing cancelled. I think what you'll see next is it'll go into a phase where basically both sides kind of ignore one another and pretend that the other doesn't exist on the surface. Of course, below the surface, trade is still going on much as normal. And then what you might see is once the issue has been allowed to settle for long enough, what you might see is an attempt at a détente. One of the factors might be political change in Japan if Takaichi was to find herself replaced by another prime minister, which not looking likely at the moment, just to be clear, but certainly given the cycle of prime ministers in Japan, certainly can't be ruled out. That would then be an opportunity in much the same way that it took Prime Minister Kishida being replaced by Prime Minister Ishiba in order for the two countries to find a way to climb down from the issue of the treated water in Fukushima and to try and reverse the seafood ban, which of course has since been once again put into place as a result of the current flare-up.
Gerard, is there an added layer of risk, though, because Washington, of course, has put perhaps Taiwan as an issue in conversations with President Xi Jinping as well? And what's the significance of President Trump calling Takaichi as well this week?
There was certainly an interesting maneuver. There was a little bit of back and forth on the call between President Xi Jinping and President Trump as to who instigated it. I believe now we're saying that the consensus is that the U.S. side instigated it. I think we saw, already that President Trump and Prime Minister Takaichi have started, they've hit off pretty well. Obviously, President Trump came to Japan very early in Prime Minister Takaichi's term. I would suspect, my estimation would be that Trump is trying to avoid any escalation in tensions, because ultimately, at the end of the day, he doesn't want this to reduce his agenda or to make any more trouble in the region.
Bloomberg Opinion columnist Road Reedy there joining us here in Tokyo with the latest on that ongoing diplomatic spat between China and Japan. This is Bloomberg.
As we weigh out what's at stake for central banks, we've gotten data from Australia, CPI numbers. These are the new complete monthly indications, and they came in hotter than expected. So that is sending the Aussie up against all its other peers. Pretty much. But the reaction is also being seen in terms of Australian government bond yields. And if you look at what swaps are pricing in, they are pricing out these chances of an RBA rate cut, and May 2026, that seems to be the next most likely venue for a trim from the Australian Central Bank. Now, of course, we are digesting the extent in which this being a new set of data actually affects the RBA's considerations. But given how everything came in well above estimates, Shery, that really is the expectation from,
and you have to really
from the Australian Central
Bank. Put into perspective where the RBA might be going with Australia, because they could barely cut in this easing cycle at a time when the RBNZ continues to need to cut given the very slumpy recovery that we're seeing there. The expectation right now for today for a cut coming from the RBNZ, 21 of 24 economists surveyed by Bloomberg expect that reduction given weak immigration as well and a soft housing market. That's coming up. The China show is next. This is Bloomberg.